Good morning. How you doing? Glad you could make it. If you want to comment, put it in the comments, either below or to the right. I had to think about that because for me, to the right is to the left. So what we're going to do is take a look at what I did was this morning I asked the entire group to vote on where they think price would end up today. And there were four choices: A, B, C, and D, and the majority of choices went to B and D. So what I'm going to do, a lot of people didn't really weigh in on this. Let's see, only about 16 people, so surprised about that. But anyways, I've done a lot of these member polls, and I found that doing these polls is enlightening because a lot of times you guys are actually correct. But here, it seems that we're all over the place, that there's a fairly wide distribution of choices here. But that's okay. So what we'll do is we'll analyze two different trades that go with at least the two top choices, B and D, and then look at it from a number of different ways. All right. So first of all, here, let's go to the charts. Here's the poll right here. Here's the chart. So what I wanted to know is where do you think price will end up by the end of the day? Will it be above this, above the node, the value node, where A is? Will it be at B, near the top, at C, where the current low of the day is, or D, that is more or less aligned, and that's the biggest node, with the past day or so, a few days of volume activity? That seems to, so for instance, the POC is right on D at about 41.20. Okay. So B is close to the close of yesterday, and it seems to be the predominant node today so far. There's a noticeable absence of volume right between B and C. So I just wanted to point that out. So why don't we start by going to the actual chart? So this is even a bigger view. And when I'm trying to decide on a trade, of course, there are a number of different criteria that I want to achieve. I want to get the right asymmetry so that I can get the right risk to reward that over time will give me a better result. Even if it doesn't give you a good result that day, it doesn't matter. Over time, certain risk to rewards give us better results. And I found this after trading this strategy now for about 18 months now, that it seems the risk to reward that's somewhere between 6 and 8 seems to have the greatest effect. It's the most profitable. That's where I get most of my risk to, my pin trades and my higher value trades. So I guess then the idea would be, well, why not just concentrate on between 6 and 8? Don't take a trade unless it's between 6 and 8. And there's a good argument to be made for that. In fact, I've noticed that I've taken a few trades that have been much lower that were just losses. They're almost always losses. So in other words, trades that are closer to the money tend to be less reliable. All right, think about that. By taking a trade that's closer to the money, by the end of the day ends up being less reliable, usually a loser. So that's kind of interesting. Taking things that are further away from the money tend to be bigger winners and overall advance our account better. So that's the first takeaway. Now, the other is okay. So what that really means is try to put on trades that are 1 to 6 or 1 to 8 in that range. Of course, there are going to be other opportunities that just make sense. You could put on a 1 to 15 trade because it only costs like 10 or 15 bucks. So what the hell? Um, an example of that might be that you took a trade early in the morning and it was a 1 to 8 trade, for instance, and then price moved away from your original where the price was when you originally put on the trade. Now it's a 1 to 15 trade. And your original trade only cost you maybe say 75 or 100 bucks, and putting on an additional position will only cost you like 25 bucks. Why wouldn't you do that? If in fact by putting that on, you're going to double your potential reward, and it doesn't even come close to filling out your max position size. So let's say your max position size is like 500 and you put on that first trade, you only put on 100. The second trade only cost you another 25. I would do that. That makes sense. As a matter of fact, some of my biggest wins have come that way. All right. So hopefully that's where I look at potentially reducing my cost basis. So now I'm into a trade and I'll go through the whiteboarding of this, but let's say it cost me 100 bucks and the reward is 800. And then I put on another position that cost me 25, say 30 bucks. So now I'm 130 bucks, but the reward now is not just double the 800. It's actually, because it's a bigger piece of the pie now it's about 1700. So for 125 bucks I'm in at 1700. And so the risk to reward on that now, say 1700 divided by 120. So now I went from a 1 to 9 to a 1 to 13 or 1 to 14. Now I'm not saying now it's a different trade, and you're saying, well, yeah, but Ernie, you said that 1 to 6 to 1 to 8 is your best trade. Sure, and I started out that way, and so it's still a 1 to 6, a 1 to 6 to 8 trade. It's just that it depends on when I took it, and may have worked away. I took that trade for a reason because of the market structure. It could just be that the market is pulling away for a bit, and then it will recover. Who knows? So that's how I generally look at adding to positions. If I can add to a position and keep it well under my max position size, but really increase my odds and bring down the cost basis of that trade. So that's okay. So that's enough said about that. All right. The other thing is that the price movement over the past 3 weeks has been very challenging, because almost every day we get some kind of reversal, and sometimes 2 or 3 reversals in that day with significant movement. Now today we also got a reversal, but it wasn't that significant. Maybe 20 points, where in other days it's been more like 40 or 60 points. So today looks a little bit more subdued. Volatility is starting to move down. All right. It's still within the middle third of our Goldilocks zone. And when I talk about Goldilocks zone, for those people that don't know what I'm talking about, let me bring up the VIX. So this is a long-term look at volatility going all the way back to the beginning of 2020. The Goldilocks zone is when the VIX is between 17 and 34. And we've been there for, the majority of the time we're there. So about 95% of the time we're inside the Goldilocks zone. When we get down below the Goldilocks zone, trading becomes challenging, but still doable, just challenging. We have to change our parameters a little bit. We have to get a little tighter because price just doesn't move that much. When it gets above it, it becomes more chaotic. And again, we have to kind of reel things in a bit. And maybe take bigger chances with smaller risk. When we're in the Goldilocks zone, we're usually pretty stable, except for this move down here. If you look at this move down, you'll see that there aren't too many other moves like this after elevated volatility that have this kind of grinding down nature. It didn't happen here. It didn't happen here. It didn't happen here. It didn't happen here. 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 Kind of happened way back here. Right? More like that. But this one actually had greater volatility, and this was actually an okay. Well, it wasn't. It was a so-so time when we were trading. Let's see. No, we weren't even trading back then. The service actually started here, right here. So I don't remember what this would have been like. But I'm just saying that this type of move down, this grinding down, is not a normal thing. It happens, 1 out of every 10 times. That's what it appears, at least looking at this chart. And generally, I think that this period of time is a period of mostly consolidation and indecision. Consolidation combined with indecision. There's probably something going on with the Fed or whatever that causes this sort of erratic behavior. And generally, the market takes it as the Fed is trying to do something good and they kind of believe in the Fed. And so volatility generally is dropping. But there's still indecision. That's my take on it. All right. And that's where we're at now. So let's bring this into bigger picture here. We're now into the lower third of our Goldilocks zone. Of course, in this area, the middle third, it seems like we do our best. I'd say that the upper third is second best and lower third is third best if I were to rate these in terms of order, where I like volatility the most. And that's just, over observation. And the only way you can make this kind of observation is if you have really good records. So that's important. All right. The other thing is that when we get into an analysis like this, there should be a very good awareness of the overall market conditions so that when you're journaling, you can make note of those. And it's not so much so that you can make a decision. It's so that, right then and there, it's so that over time, when you're evaluating your journal and your logs, you can see patterns, correlation, volatility to this type of behavior in me or the market. And the reason why we want that is so that we can do what I was talking about today's earlier video, is to do course corrections every once in a while. Maybe we've taken on bad habits and we need to course correct and get back onto our path. That's why we do the logging and the journaling, so that we can see patterns, and on a slower basis, maybe every week, every month, every quarter, we can take a look and see if we need to course correct. All right. So knowing your entire environment is really important. You got to look at trading long term. If you're looking at trading short term, it's not going to work out for you. This is one of the reasons why, and it's the tendency of most people in trading to want to look at it short term because they can't understand the long term. They can't even understand the short term. And that's one of the reasons why high probability trading is so attractive to people, because they have this myopic view and they can see, oh, I made like 7 out of 10 wins, and so this must be a great strategy. But then when they expand it out to months or years of trading, they find that it's a horrendous strategy. So that's why we need to do this kind of exercise. And also, you're getting a leg up by understanding that the longer term view, the low risk, high potential profit way, aka lower probability trades, have a much better chance of success over the long run. But you won't find that out until you actually practice it and start proving it for yourself and all that. All right. let's go to the market here. Now, it appears that we have a general direction down here, but it's still unclear. We don't have, this is kind of what's called a distribution day. In other words, there's a grinding down. It's not like just move sharply down or sharply up like we have over here. Move sharply up, sharply down. Here we have what is termed more of a distribution day. And I would expect that we're either going to stay in this range or do the same sort of thing moving down, maybe down as far as D, that area. Now you notice I put A, B, C, and D to sort of coincide with the major consolidations that have happened over the past, well, it looks like over the past week or more. And generally, that's what we're trying to find out. We're trying to find out where are the major areas of consolidation and the major areas of not consolidation or volume wells or impulsive moves. And those are indicated by volume wells because we know that the behavior will more or less be dictated by where there is congestion or where the market finds value and where the market doesn't find value. Where the market doesn't find value, price tends to move relatively quickly versus where the market finds value tends to move a little more slowly and deliberate and tends to hang around there because there's a consensus in the market about that particular area. That's the whole reason why there's a value node in the first place, because the market as a consensus is finding value there. And so it wants to be there. When it moves out of that area, it's usually because of some shock to the system or new information that's come into the system that says, hey, this area is no longer our most attractive value area, so we need to find where that is. So through price discovery and through lower liquidity, because now it's shocked us out of that value area, the larger time frame players, aka whales, institutions, that sort of thing, now have the ability to move price very easily because of that lower liquidity and move it to a point where it finds more value. That's generally how markets work. You know, whenever an institution or institutions or whales or other people that simultaneously find an opportunity to move price in a direction that will benefit their strategy, whatever it happens to be, they'll do it. And if a economic report or a Fed governor comes out and says something, or a president, or some kind of event happens that will put that kind of energy into the market and shock it enough to move it outside of that value area, they sense that opportunity and they're going to take advantage of it. We don't know what their strategy is. We don't know if taking advantage of it means move it up or move it down. We have no idea. We just know that we can see the behavior. The problem that's happened over the past few weeks, and particularly this last, say, week, has been that there's been very little information coming into the market that has caused these huge moves, these intraday reversals. They just happen. It's like schizoid type behavior. The market, the bigger players are always trying to move it, and they don't know where to go. They don't know whether to believe the Fed or not. They don't know if we're in a recession or not, or if there is inflation or not. And so there's a dichotomy of opinion. I think that's what's happening. But that doesn't help us because it makes it more difficult to try to pick a direction. You know, you pick a direction and, you know, you'd think, oh, my chances are 50-50. But then, I don't know, maybe using some of your own sensibilities, they tell you to pick a certain direction and then it ends up being wrong. And it could be wrong, you know, 70% of the time. It's not necessarily a random thing. I think the best way to describe this is that you pick a direction based on what you know as logical, but the market isn't working with logic at that point, or it has an underlying narrative that you don't understand yet. You know, I've often pointed to this idea of opposite world, that most people look at that and say, well, that's crazy. Why would a market go up with bad report? Or why would it go down on a good report? And that's because you don't understand the underlying narrative. If you understood the underlying narrative, then you would understand why it went the opposite direction. Sometimes we just don't understand the underlying narrative, or the underlying narrative is unknown. Maybe there is not one, or maybe there's a number of competing ones. And I think that's what is going on right now in this bear market rally, that there are a number of underlying narratives by big players that are competing. And no one really knows, well, which one's going to win. And the Fed, who most of the market is looking for direction, is giving mixed signals or erroneous signals or made up. The Fed mostly is using the power of their pulpit to affect what they want to happen, regardless of whether or not that comports with reality. They think that reality is whatever the market believes, and if they can make the market believe their reality, then they think that's where price will go, or that's where the market will go, or that's where interest rates will go, or that's where volatility will go, or that's what they believe. Actually, that is primarily the fundamental precept of the Keynesian Keynesian philosophy, that it all comes down to sentiment. And if you can control the sentiment, you can control the economy. That doesn't help us very much because it's illogical. So that's why you can't really use, fundamentals and logic here. The best that you can do is more or less put on swags, a scientific wild ass guess. I use that term a lot. And take small bets so that when you're wrong, and you'll be wrong because, your logic is sort of interfering with what is actually happening, you won't lose a lot. And when you're right, you'll gain big. So that's really what we are doing here. I don't know if there's any comments or if anybody has anything to say about that, or what is your opinion? All right. All right. So let's get to these trades that we're talking about. So if there are two ideas here, well, there's four ideas, but two that seem to be bubbling to the top, B and D, then we need trades that will make sense. So earlier today, I put on a couple of trades when we were talking about them. All right. And one is aligned with B and the other one is aligned with D. Now, if I look at them separately, they're both good trades, good risk to reward. This particular one here is 10 wide, centered on 160, which is right near B. And it was taken when price was out here, got a fairly good price, $1.35 for 10 wide. So what is my risk to reward on that? So it's 10 wide. Let me bring up the calculator. So it's 10 wide. That means that the maximum potential profit is 1,000, but it's 1,000 minus the debit. All right. Of $1.35 or 135. So there's my maximum potential profit if I pinned this trade right in the middle and the market ended up there. Now I would divide that by the risk that I took on to get my risk to reward. So now it will give me the ratio between my risk or the debit and the potential profit. So I divide it by 135. All right, so that's right inside my comfort zone, 6 to 8 at 6.4. So that's good, right? That's a good trade. And right now it's in profit. Just a little bit, but it's in profit by about $30. It has, I mean, if we closed right here, it would make about $130. And I can see this price over here in the lower left. And by placing my cursor right at that price, I can see where it intersects the cyan line. And on the lower left, it tells me what that profit would be at expiration, $163.60. So ideally, I'd like to be somewhere near 160, because if I closed at, say, 157, right, right there about, then this trade would return $581. Now, one of the other things that I always do is I want to put on commissions on this, so the chart reflects the actual commission in the trade as well. That's important. That's a fundamental thing that a lot of people miss when they're doing their analysis or back testing or anything else, or even their logs, that they don't include the commissions and the fees. Very important. All right, so that's this trade. That's the B trade. Let's take a look at the D trade. I'm going to look at it separately. Now, when I put this one on, it only cost me, was it 80 cents? Let me just check here. Yeah, it cost me 80 cents. All right, so what was that risk to reward? And it's down now, right now. So again, it's a 10 wide, so it's $1,000. I don't have to go to 1,000. I can just say 10 wide, right? And the cost was 80 cents. So I'm going to subtract 80 cents. And my potential profit is $9.20. Divided by the 80 cents will give me my risk to reward. So my risk to reward is 11.5. So that's outside of my perfect area. However, it's still I've made really good trades up in that area. But that's okay. Right? Now, the way I look at it is, if price does go down here, I'm going to profit. I'm going to profit nicely and with good risk to reward. Now, both of the trades on, I don't look at these as, hey, am I going to go for both of these by the end of the day simultaneously? And that doesn't give me the kind of risk to reward that I'm looking for. I look at these as two separate trades, right? So here's my first trade. If I feel that price is going to hang out here, then I'm going to stick with this. And if I make good profit, and if it does stay here, then that's great. If I feel like the market all of a sudden is just taking off, and it all comes down to timing, really. I could decide, hey, I'm just going to take this trade off, and let's say that it had gained $100, then I would have made about 80% profit on that trade. So now I'm sitting at with say $100 in my pocket, and I have this other trade on that cost me $80. I'm in for a free ride for potentially going and profiting on that trade. That's the way I would look at it. So that's all sort of predicated around the idea that I think that price is going to hang out somewhere between B and D. So I can profit on one and set myself up for an even better profit on the other. But, let's see how things progress. The other possibility is that price just takes off and goes north and then wipes out both trades. All of those are possibilities. Now, one thing that I'm looking at here, so there's the setup for the two trades and why I might have taken both of those trades. Pretty good reasoning. The like I said, the between 6 and 8 seems to give me my best results. Let's take a look at my log, my trade log. All right, so I haven't entered yesterday's trade yet, so that brings me down a little bit down to here. I lost about 300 bucks. So now I'm still positive, but not where I'd like to be, and still way above my what I think my overall return should be. And so I'm still fine with where I'm at. I'm frustrated because I've been going sideways, and because I'm also growing this particular drawdown. But it's still, from my point of view, I'm still fine from a long term perspective. I would like it to be better, and I would like to increase my odds and take better trades, and maybe I can grind my way out of this until a pin trade comes along. Maybe that's what I should be concentrating on. But that will change my strategy a little bit, and I'm not really a fan of doing that mid course. I'd rather just stay the course and just keep on doing what I'm doing. And if this drags on for more time, hey, it drags on. But I've shown you in the simulator that trades like this can drag on, or situations like this can drag on for a long time, sometimes 50, 60 instances of trades. And there's nothing you can do about it. It doesn't mean that the strategy isn't correct. It just means that's what the market is dealing you right now. Pain, and you have to figure out how to turn that pain into not pain and just an understanding of that's where you are. So the important things to me are, in my trading, am I getting the right kind of return distribution? Because ultimately, I want a distribution that is skewed heavily towards, from zero, actually a little bit less than zero to a little bit above zero, and have long tails to the right of zero. This is my ideal shape. And then, of course, here's my distribution of my trades in terms of risk to reward. Looks like 8 is my, most of my trades. And so that's good. I'm putting on most of those. I'm trying to eliminate these 3, 4, 5s because those show my worst performance. So this is what I'm trying to achieve, this distribution. Let me zoom in on it a little bit more so you can see that. That is what I'm trying to achieve. And so right now, at least according to my long-term plan, I am perfectly following my long-term plan, I think. Regardless of what the current outcome is, this is right spot on. This is where I want to be. And if I keep on filling in this, and if it creates that kind of shape that I want, then that's exactly what I want. Let's take a look at let's take a look at this. All right, let's take a look at this. This is an area that I have talked about before. Talked about distribution. You know, this is a normal distribution where where the instances of your trades are equally distributed left and right. Um, this is basically high probability trading. Actually, this isn't even high probability trading, but this is basically going to get you nowhere. This is better than high probability trading, right? But basically, you will end up with, on average, end up at zero. Or, you know, no wins, no losses because of your long tails are equally distributed on the left and the right. It depends on what your kurtosis is. The kurtosis is the height of your trade of your distribution. The skew is the delta between your mean, what is a normal distribution, and so if your median was here, that would be your skew. All right. So here's a bad skew. This is high probability trading. That's what it looks like, where they have no long tail profits, but they do have long tail losses. However, this is what attracts them, is this area here. Lots of tiny wins. This is what we're going after. And if you notice, this looks a lot like this. All right. We recognize that we're going to have a lot of losses and some small wins and a smaller percentage of big wins. This is the goal of pro traders. This is what they're trying to go after. This is the ideal situation, because they know that over the long term, this is a winning strategy. So if you're wondering what you're going after, that's what you're going after. And the reason is, if we were to take a look at the simulator, right? So I'm simulating 3 different size accounts: a 3,000, a 20,000, and a 175,000 account. I'm doing slightly different trading position sizing. I have fixed position sizes on account 1 and 2, and then a variable position size on 3 that is based on the size of my account. All right. I'm looking at a 45% win rate, which is about, about what it should be. I could go down to 40. I can see that there's still positive cases for that. I can even go down to 35. Let's see what 35 will give me. All right, so that one failed. All this means is that I hit my my break point. All right, but let's calculate a new one. So even at 35%, you can have fantastically winning strategies. Where the gray area, we're looking at the trader 3. All right. So even at 35%, I mean, it's hard. But, that would be really unusual that you average 35% over a long period of time. But you can see that it still comes out, for the most part, most times, positive, sometimes hugely positive. All right. But generally, I think 45% is, or 40 to 45% is probably more normal. So let's take a look at the average trader with, say, 20,000 bucks, and we'll go right to his page or her page. Take a look at this one here. This is very similar to what I am experiencing now. Actually, it's worse. But over time, it ends up better. All right. And you can see here, starting at 20,000, here, it's not until I'm at about, let's see, the 70 or 80th trade that it starts getting out of this drawdown. Here's the drawdown right here. It then starts making some progress. Can you withstand 80, 70, 80 trades of doing nothing? That's the question. Can you do that? Are you going to be questioning yourself? Is this strategy even worth it? Does it make any money? I mean, clearly over time, if it catches the, the gear, it does. And this is on average a 46% profitability, right? We could bring that down to 40%. You'll see the same thing. That percentage doesn't affect too much. Let's go back to traded 2. All right. Look at this one. This guy made it right out of the gate. That doesn't happen very often, but it does. It can. All depends on your particular situation. Everyone's different. Every instance is different. Let's do another one. All right. This one still made money over this period of time. This is 500 trades, by the way, but went sideways again for a long time. 106 trades. This guy got lucky or gal and just went straight up. These are all realm of possibility. Same strategy, same everything, same risk to reward. There might have been differences in their overall strategy, but that's why we course correct every once in a while. But generally, this is using this type of strategy where you're expecting to trade about 40, get a 40% win rate with this kind of range, median range of winners and losers. And if you're trading the SPX, this will be a round trip fee, $6. Right? And over 2 years, this particular instance, this person who started with $20,000 ended up with a little over 35,000. So, is that significant? From a trader's point of view, it's really significant. So, it's a 57% increase over 2 years, or an average of, say, 20% per year, 22% per year. If you traded like that year in, year out for the rest of your career, you would be considered a trading god. Right? And to most people, they're thinking, man, I just want to turn my 20,000 into 100,000 tomorrow. Expectations are really important. So I guess we every time I want to go into and talk about a particular trade, I feel the need to go back and revisit the big picture. Like I did this morning when I wanted to talk about this morning's routine and how it had been disrupted and I wanted to change it. I felt the need to go back and visit the big picture. Always go back and visit the fundamentals and what it is that we're trying to accomplish. So important. All right, let's go back to traded 2. And in this instance, a 40% win rate and did really well, right? Big drawdown in the beginning. Well, not a huge drawdown, but it significant enough. 9% drawdown. That's not a lot, in most trading systems. Anything under a 10% drawdown is considered really, really good. And it's very rare that we go more than that. Usually it's in the 5 to 6% range max. Right now, my uh, my drawdown isn't anywhere close to that. So I'm still doing well. My max drawdown is currently 2.67%, and I'm in it right now, a little above it. Actually, it's going to go down a little bit more because I do have another loss to record in here. So I'm perfectly comfortable with where I'm at. Am I frustrated with the market? Absolutely. Am I trying to correct? A little bit. I'm trying little things. Like one of the little things that I'm doing, one of the um, processes that I engage in, is the idea of looking at new alternative strategies that I may be able to add to the mix, because a diversity of strategies sometimes is good. And not too much diversity, just a little bit. And that's why I'm looking at the final hour trade, seeing whether or not that has, or if I can even learn something that can be adopted into the current strategy. It's the reason why I'm doing the final hour trade. Besides the fact that I think people like watching somebody trade every day and doing the same thing. All right, let's see. Let's go back here. All right, so I'm going to now go back to the trade. Let me just set it up and see where we're at. Looks like we keep on going back and forth. All right. So here's the B trade. The B trade right now is profitable. Not very profitable, but profitable. Looks like about $27. So if I took, now I'm not going to take this trade off right now because it's just too early. But 27 divided by 135, it's 20%. I'm at 20% return right now. Most traders would love to have 20% returns on their trades on average. For us, that's like, I wouldn't even consider taking it off there unless that trade was, I can't think of I guess the only time I would take a trade like that is if we're near the end of the day and I'm sitting outside of the profit tent and I've got a 20% return. And instead of taking a max loss, I'll just, I'll accept the 20% return. That's the only time that I'll take a 20% return. Right? So did you get that? It's 3:50 or 3:45 in the afternoon. I'm sitting outside here and my trade is worth 20% return. There's probably little hope that I'm going to move into my profit tent or gain very much. Price is a little bit volatile, or well, maybe even price started to die down. I would just take it and get out. Why would I not take it and then take a max loss? That'd be one of those. Most of our trades are taken right outside the profit tent, by the way, near the latter third of the day, because they might be at 100, 150, 200% return. So just take it. If it happens in the next 15 minutes to move inside and you miss out on a lot, well, that's the way it goes. I suppose if it had moved in there earlier and you were already there, you would probably be holding on more. All right. So right now, everything seems to be performing okay. This trade here is offsetting my trade by a little bit, but overall, it seems that I'm profitable between the two. Maybe just about break even right now. If we stay anywhere between these two, I believe that anywhere from here to here, this profit curve is going to grow, and it's going to grow Yeah, let me go back to the whiteboard and describe how it's going to grow. Let's draw the risk graph. And then the two strategies. So I have this strategy, and then I have, oh, what happened here? Somehow I lost the color. All right, so you can see I made the difference between the two risks. And then my profit curve right now is kind of like this. It's not quite that, but as the day wears on, it's going to start looking like this, right? It's going to grow between the two. And then as the day wears on even more, it's going to start doing this, something like that. And then something like that. So I know that there's a time during the day with these two trades, and I'm not sure exactly what times these all are associated with, but that's generally how that profit curve is going to grow. But if I'm right in the middle here, and I'm right here, and I can pull off maybe a 50 to 100% return off of both of my trades at the same time, I'll probably take it. All I have to do is just remove both trades. You know, that's okay to me. It's probably not the, you know, the type of risk to reward that I would want to try to go after every trade, but that might be the way I would look at that. Because if I'm right in the middle and price is slowing down, you know, is there a chance that it's going to go one way or the other, and is it going to make a material difference? It could. So, for instance, if I'm on this curve right here, and we're sitting in the middle, and all of a sudden price starts moving one direction or the other, one's going to become much more profitable than the other, and it may end up being cumulatively way bigger than this. So there are a lot of decisions I have to make. I have to study this and figure out, well, what has price action been? Where I'm at now? Does it look like we have a chance? All right. So back to this. Let's take a look at our original trade here. It's growing. Right now, it's worth about $32. So now, if I got out of this trade, let's say that it grew to 100. Let's say it grew to $80. Right? Would I take it off? I might, because $80 would give me a free ride. Because the other trade only cost $80. Right? Then I'd have zero risk in it. Well, let's say it grew to $100. Would I take it off? It depends on where I am in the day. If it's early on in the day, I might take it off because, again, I would have a guaranteed profit, and then I would have a free ride trade over there. You know, it could also be that here's a good example. If I go back to this, if I go back to this, I mean, I could be sitting right here, right? And maybe it's noontime. And cumulatively, or this trade right here might be worth, say, $125. Now, this trade cost me 80 right here. But if I can get out with, say, a 90% return, because this trade right here cost me 135 approximately, I would come out of that with the difference between these two of $45. So no matter what happened, I'm a $45 winner here. If I take trade A off and leave trade B on. So that's a good situation because I have $45. I have a free ride on trade B. If price starts near now, I'm sitting here with like 2 or 3 hours left in the market, I would just leave trade B on and see what happens. I mean, what if any movement at all towards B is going to improve my position with a potential of, pinning too. So that is a great trade right there. Are there no questions on any of this? Are you all just sort of taking this all in and it makes sense? I guess so. Yeah, that's a very good point. That you might win both sides, and this is a case where you might win both sides, and this happens to me a lot. Now, I will often take an additional trade, thinking that the state of the market with its volatility, that I'm going to be able to profit from both simultaneously or both individually. All right, let's see. Let's go back to the chart. So here's the A trade. Interesting thing. The profit curve is acting pretty nice today. It is moving up relatively fast, to the point where I can almost watch it move, and that's cool because in another hour it's probably going to be at 100. And at that point I'm going to probably make a decision. Do I just want to grab a guaranteed profit or not, or do I want to hang out here for the potential that it might go even higher? So I'll have to make some sort of calculated decision, maybe a range. I would say, well, if it goes to 80, then I'm going to get out. If it stays above 80, I'll stay in. Right? Something like that. And then as it grows, then you might be able to raise that amount. Say, well, if it goes to 90, I'll get out. Above 90, I'll stay in. And as long as it stays above 90, maybe, and then 100, then you stay in. And then maybe it goes to 200. You say, okay, I'm going to give it to 150. I'll stay in. So kind of like a mental trailing stop in your head. Because right now it's worth, $37, $32. I saw it go up to 47. It was briefly 50 something. So I'm watching that. All right. Well, that's about all I have to say. Hopefully this is helping you in how you make your decisions. So going back to the fundamentals, what is it that I'm after? I'm after creating that long tail right hand distribution. Really, that's what I'm after. I'm after trying to keep my initial choice for a trade between 6 to 8 risk to reward. I am after trying to create the widest possible trade that I can, as close to the money as I can, while maintaining that 6 to 8 risk to reward. All of those things contribute to that the shape of that curve that I'm trying to do, that distribution. Now you'll find that if you stick to that in markets like now, this really unknowable weirdo market, your win rate's going to be low. But there's going to be a time, I guarantee it, where your win rate is going to explode. Last year, we had a period of 6 to 8 weeks where our win rate was like 90%. That happens, right? So don't think that it's your methodology. If you're losing too much money, all that's saying is that you're trading too big, right? And what is losing too much? I mean, you saw that when I run the simulator, it takes a lot of instances to get down to whatever my drop point is, right? And usually my drop point is like, I don't know, 30%, 25 to 30% of my trading capital, where I feel like, okay, this instance was just bad. Let's cut it. If I go back to the simulator, you'll see. You see that, well, here I made this one at 50%. See, my cutoff, the cutoff is the drop point. For the $3,000 account, I made it 2,500. That should probably be more like, I don't know, 2,000. Right? I made it 2,000 there, and then it showed a lot. This particular instance was a failure. It went all the way down to 2,000. See it right here on the 29th trade. Did it do that on this guy? No, it didn't reach 10,000. Just barely. Where did it go? How low did it go? Yeah. No, never really got there. See, it only got down to about 17.7 on the 38th trade right here. What about trader 3 with the bigger account? For whatever reason, this bigger account just did not like this go around. You know, I would probably, after 100 trades, say that if I'm not doing anything, if I'm not really picking it up, I'd probably say I got to change something up. So that's this particular instance for 3 different traders, same data set, same trades. All right, so here's another one where the third trader with the bigger account did okay. I mean, doubled their account over 2 years. That's unbelievable. But still only traded 40%. Had a cutoff at 125,000, starting at 175. I think the lowest they ever got was in the beginning, somewhere right around here, at about 171,000. Look, oh, it's 170,000. Yeah, so lost about $4,000 or $5,000 in the beginning, and then was very fortunate. Then started to slowly claw up. So this is a good expectation reminder of what this, what are the possibilities of any time. So let's be very clear that you got to look at your trading as if you're in a particular universe. And then there could be, say, parallel universes of you doing the exact same trades or confronted with the same price scenarios, but you act a little bit differently. That's what it's like running this simulation. In the same instance, same conditions and everything, you might act a little bit differently and get a slightly different result. So all of these different return possibilities are possibilities. They are not one gave you this much because you did this, or one gave you that much because you did that. They are all basically, using approximately the same criteria for your trading, and those were the results. And I get that is a hard thing for people to swallow. They think if you do A, B, and C according to the formula, then you should come out with D. Period. End of story. No fluctuations. That's not life. That is simply not realistic. All right. So I think I've exhausted these ideas here. I don't know if anybody has any questions, any comments. Well, it looks like most people left the stream, which is unfortunate because apparently a lot of people didn't find value in this. Probably the most valuable, perhaps the most valuable stream that I have ever done. And that says something about people. I'm surprised. All right. So now I'm going to end this stream and I'm going to go and yell at the membership. Peace to you all.